Ladies and gentlemen, good day and welcome to Avalon Technologies Limited Q4 FY24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. And I'll hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, Ms. Nair.
Thanks, Neil. Good afternoon, everyone, and a warm welcome on behalf of DAM Capital for the Q4 and FY24 earnings call of Avalon Technologies. We have with us today from the management, Mr. Kunmant Bicha, the Chairman and Managing Director, Mr. Bhaskar Srinivasan, President, Mr. R.M. Subramaniam, CFO, Mr. Sriram Vijayaraghavan, Group Chief Operating Officer, Mr. Venki Venkatesh, Group Chief Sales Officer, Mr. Michael Robinson, Chief Operating Officer for US, and Mr. Suresh Vyas, Head of Corporate Planning and Investor Relations. Mr. Kunmant Bicha will give a brief overview of the business performance, and it will be followed up by the CFO, Mr. R.M. Subramanian's remark on the financial performance, post which we'll open up the floor for Q&A. As we move forward, it is important to bear in mind that any forward-looking statements made during this call are subject to potential risks and uncertainties, both known and unknown. Without further delay, I now hand over the floor to Mr. Bicha for his initial remarks, post which we'll open up the floor for Q&A. Over to you, sir.
Thank you, Bhumika. Ladies and gentlemen, on behalf of Avalon Technologies, I extend a warm welcome to our Q4 and FY24 earnings call. As we conclude our first financial year as a listed company, I sincerely thank you for your ongoing support. Before we dive into financials, we would like to highlight key differentiators of Avalon Technologies, especially for those who are joining us for the first time. Avalon Technologies established itself as a key player in electronic manufacturing services with a global reach. We take pride in our leadership in high-mix, flexible volume manufacturing, servicing a diverse range of industry verticals in complex integrated solutions that require significant engineering expertise. We currently operate across 12 manufacturing facilities in India and United States. We are also adding 2 new manufacturing units in India. Our 3 key differentiators are: 1, vertical integration. We are a one-stop shop offering a true box build from PCB design to manufacturing. That involves PCB design, new product development, cable assembly, sheet metal, plastics, magnetics, testing, and logistics. 2, global presence, both in terms of manufacturing facilities and customer base. 3, optimal mix of established industries like industrial, rail, aerospace, medical, communication, and emerging industries like clean energy. There are many positive updates I would like to share about FY25, but first let me begin by reflecting on FY24. FY24 presented a mix of challenges with significant shifts in the U.S. macro environment. Despite our initial optimism, we had to adjust our estimates in late Q1 FY24 as our customers across various industry verticals reduced their inventories. Consequently, we took a more cautious approach in the later half of the year and projected an 8 to 10% year-on-year revenue decline. Ultimately, we ended up with an 8% decline, primarily due to a 16% year-over-year decrease in our U.S. revenue. Our high fixed costs negatively impacted our operating leverage, further reducing profits. However, our Indian manufacturing, which serves both our Indian and global customers, representing 77% of our business, remains highly profitable with operating margins of 12.7% and PAT margins of 8.5% during the year FY24. Now transitioning to FY25, our early expectations of a recovery in H1 and significant momentum in H2 seems to be materializing as anticipated. We are seeing positive signs and believe FY25 will be a pivotal year for us. Here are a few highlights to underscore our optimism. Our order book witnessed a year-over-year growth of 11% to rupees 1,366 crores, with an execution period over an average period of 12 to 14 months. Long-term contracts, in addition to the order book and executable over the 2 to 3 years, grew year-on-year by 58% to 949 crores. There are concentrated efforts on inventory management. Absolute inventory levels decreased by 10% from December 23 to March 24. We remain on track to reduce our net working capital days by at least 10 to 15 days in the next 9 to 12 months. Importantly, we categorize our business focus areas as 3 growth engines, all of which are regaining momentum in FY25 after encountering challenges in the previous year. Now let's delve into each of our growth engines. First growth engine, new customers in the US. Starting with our major clean energy customer that we previously discussed, we are pleased to share that long pending product compliance certification for their home electrical system has finally been approved. This is a significant milestone and in line with our earlier communication. The commercial launch is expected in late Q2 FY25 with production ramp up anticipated in H2 FY25. The scale up of this business is expected to be significant in 26. We are also happy to report several major new wins with industry-leading companies in the industrial and automotive segments. For some, we have secured box build contracts, while for others, we will begin with PCB and cable assemblies. We have received prototype orders now with commercial production expected in H2 of FY25. These are existing products with established companies, and we believe they can significantly scale up in FY26 and has the potential to become some of our top 10 customers. For example, one of them is a market leader in motion control systems in the mobility segment. Another is a major backup power generation products for residential and industrial markets. We will provide more updates on the same in the coming quarters. With the Inflation Reduction Act bolstering clean energy manufacturing in the US and India emerging as a significant beneficiary of the China Plus One strategy, we are confident that our presence in both regions position us for winning new sizable opportunities. Second engine of growth, existing customers in the US. These are industry-leading, well-established companies across various industry verticals with whom we have partnered for many years. Last year, this growth area faced a significant challenge due to factors such as inventory destocking and macro uncertainties. We now believe that the inventory destocking cycle has bottomed out. The restocking cycle has begun for our US customers, albeit at varying rates. Our efforts last year to gain wallet share with certain customers are also proving beneficial. In a sense, we believe the shift from destocking to restocking has begun and will become more prominent in H2 FY25. With respect to aerospace customers, we have entered the cable harness and lighting products, and we have also signed a 15-year master term agreement with one of the global aerospace majors. We also expect recent order wins in aerospace segment to commence execution in Q4 of FY25 and ramp significantly FY26. Third growth engine, India customers. Looking back at our business 5 years ago, we were predominantly an export-focused company, with nearly 75% of our revenues generated outside India. However, over the last 18 months, we have actively started focusing on the India market. We have made significant inroads in the industrial, rail, defense, and EV verticals. Today, revenue generated from our India customers contributes 46% of our overall revenue. Speaking of major wins in the India market, let us start with rail. One of our major Japanese customers from the railway vertical has recently been approved by Indian Railways for an advanced version of the signaling and interlocking system they currently supply. This represents a better value proposition for Indian Railways, and we expect to learn more about this development in the coming quarter. Additionally, this customer is also approved for the Kavach system in Indian Railways, and we are actively collaborating with them on this initiative. This further strengthens the relationship with them and augments our business growth potential with the railway segment. We are also delighted to announce major wins with some industry-leading customers in the industrial and energy segments. We have secured prototype orders with them and expect ramp production in FY25. These partnerships have the potential of becoming significant revenue contributors in late part of 25 and 26. While we have made progress in the defense sector and communication markets, we anticipate more meaningful order bookings to occur in H2 FY25, with execution expected in 26. Transitioning from a detailed overview, we see all three of our growth engines are gaining momentum at different stages, fueling our confidence in significantly scaling our revenue over the next 3 years. While we believe we can comfortably double our revenues in this period, we want to remain cautiously optimistic for FY25, predicting a 14 to 18% revenue growth. In continuation of our earlier discussion on preparing our organization for years of growth, we are pleased to announce the appointment of our new Chief Sales Officer, Mr. Venki Venkatesh. Venki brings over 30 years of experience leading high-performing global sales teams and closing large deals in our target verticals. On the infrastructure front, we are in the final stages of completing our new factory in Chennai, which will be operational this quarter. This plant will cater to our export demand. Additionally, to meet our anticipated domestic demand, phase 1 of our brownfield plant expansion in Chennai is expected to go live in Q1, with phase 2 following in H2. With the revenue growth we anticipate in the coming years, combining our team and infrastructure in place, we expect the operational leverage will play a significant role in our favor. Profit growth is expected to outpace revenue growth. This is underpinned by the following reasons. 1, we maintain industry-leading gross margins and have not pursued low-margin businesses. We expect to sustain our gross margins depending on product mix and ramp-up. 2, majority of our costs below the material costs are fixed in nature, allowing operating leverage to flow through as revenue ramps up in H2. 3, our dedicated focus on improving working capital will help us release some cash, further supporting our growth and profitability. In summary, it is evident that we have navigated a challenging year and we anticipate a recovery in H1 followed by momentum in H2. The coming years appear promising, with FY25 being pivotal for our growth trajectory. I would like to stay consistent with our message that is essential for us not to lose sight of the long-term vision and opportunities while dealing with short-term macro challenges. Notably, the U.S. market is transitioning from destocking to restocking, which will positively impact our growth. We are preparing our organization for years of growth ahead. Avalon stands strong, building a business that is focused on long-term profitable growth rather than growth at any cost in the short term. Thank you, Anand.
So shall we open the floor for questions?
No, we have, and our CFO, Arun Subramaniam, will talk on the financials.
Thank you, and good evening, everybody. Thanks for joining the call today. As we come close to FY24, I would like to thank the entire Avalon team and all our stakeholders for the confidence they have placed in us. I believe we are uniquely positioned with our hybrid business model, vertical integration, and diverse sector mix to benefit from one of the greatest industry moments that India has seen in recent years. FY24 was a tough year for us with several macro challenges, primarily around the demand scenario for our US customers, largely driven by muted macro and recessionary headwinds. Despite this, we continue to grow our order book by growing our existing customers and winning new customers and making deep inroads into our business segments. While we believe we have passed the lows and are beginning to see the green shoots of recovery, we continue to reiterate that products we make and the industry we serve are present in our fairly complex, and our ramp-up period is generally of 6 to 9 months. Given this, some of the wins we had in FY24 will take time to ramp up, and we see the momentum picking up in H2 FY25. For the full FY25, we do expect to see revenue growth of around 14 to 18% year-on-year, primarily driven by H2. Since our profit is strongly tied to our scale of production and revenue, we accordingly expect H2 to be much more profitable for us than H1, and FY25 as a whole to be significantly better than FY24. Now, moving on to performance in FY24 in detail, financials. Our revenue from operations was rupees 867 crores, a decrease of 8.2% year-on-year. This is in alignment with the revised guidance we have given in Q3 FY24, and we expect to see improvement here on out. Gross profit was 315 crores, down by 9.2% year-on-year. Our gross margin stands at 36.3%, and we were able to maintain it around near FY23 levels. We continue to maintain industry-leading gross margins as a factor of our unique hybrid business model and premium quality of products. We are also selective in terms of pursuing profitable growth rather than growth at all costs. Coming to EBITDA, EBITDA was at 62 crores, down 44.5% year-on-year. EBITDA margin stood at 7.2%, and decrease of 472 basis points on a yearly basis. As mentioned earlier, we continue to have a fair share of fixed expenses, and the muted revenues will accordingly result in lower operating profit. That stood at INR 28 crores, down by 46.7% year-on-year, and PAT margin was at 3.2%, and decrease of 230 basis points year-on-year. Revenue from our India manufacturing side that serves both our Indian and global customers is around 77% of the total revenue. The EBITDA and PAT percentage pertaining to India manufacturing are at 12.7% and 8.5% respectively. We continue to be among the forerunners in terms of margins in this business. The US manufacturing reported a post-tax loss of INR 30 crores for the FY24. We expect this to improve in H2 FY25. In line with the cost optimization exercises, there is progress at our US entity, and the employee cost has been consistently improving. Regarding the transfer of production from our US plant to our India plant, we have received approval to shift production for nearly 50% of our existing US manufacturing customers during FY25. We have already begun the production transfer for approximately 30 to 35% of these customers. Moving on to the balance sheet side, our net working capital days were at 161 days as of March 24, comprising of 118 days of inventory, 79 days of receivables, and 36 days of payables. We have managed to bring down our inventory levels by around 10% on absolute level, owing to our customer demand recovering in the US and our rationalization efforts there. Our supply chain has normalized, and we will derive benefits from this stability going forward. While we had earlier anticipated a sharper improvement in working capital, we expect to take a longer time frame due to our larger customer base and signing up of new larger deals. We continue to improve our payable days and are aspiring to reduce our net working capital cycle by 10 to 15 days over the next 9 to 12 months. Because of all the efforts we have taken, it may be noted that for FY24, cash flow from operations post working capital changes was positive at 17 crores. As at the end of FY24, we have liquid cash in terms of investments and FDs of approximately 118 crores, out of which 50 crores is earmarked for debt repayment in our US subsidiary, and the surplus will serve as reserve and growth capital. Additionally, we prefer to keep existing working capital lines in India available, amounting to 185 crores. The open working capital lines have markedly improved our ability to bid for larger orders, which will reflect in the upcoming quarters. In summary, our FY24 performance was characterized by lower top line, largely due to inventory rebalancing, a challenging macro environment in the US, and a focus on optimizing our cost structure. However, we believe we have reached the bottom and have begun witnessing green shoots of revival. We have successfully moved some of the products to India for manufacturing and optimized our fixed cost in the US in alignment with our strategic plan. Additionally, we have strengthened our senior leadership team through lateral hires at the CXO level. We have utilized this difficult period to focus on building up of the organization, and we expect to see the results of these efforts, the ramp up beginning in H1 FY25 and continuing strongly into H2 FY25. Throughout this process, we'll continue to focus on winning quality customers and maintaining our brand equity while upholding industry-leading margins. In conclusion, I believe that we have reached the end of the tunnel and are now poised to scale up our business in FY25 and beyond. Thank you. Bhumika, over to you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Arafat Syed from Incred Research. Please go ahead.
Yeah, hi sir. Thanks for taking a question. My first question is on new client addition in new sectors. Let's say early that clean energy not doing well, especially in the US. And how is the situation there? If you can guide me something on that. What's the, let's say, outlook on clean energy first? And that's my first question.
Thank you, Arafat. To answer your question, clean energy is a temporary slowdown. So we anticipate the same rate of growth as we go into the future, because some of the key wins we've had have come from clean energy. And if you take an example of our home electrification system, the project had been delayed. Now we are certified, the customer is satisfied for all the compliances, and we have started the prototypes, and we see a major ramp of that in the from Q2 of this year and full production in H2. So we are not seeing a decrease in that. Over a 3-year period, that should grow much faster than the rest of our industry. But the destocking of our existing customers have also affected that.
Yeah, and my second question is, and my next question is on your, let's say, aerospace and defense you recently added, and you are saying you got a big client name also you added. So can you throw some light on that? Let's say what kind of growth you're looking in this space in the next 3 to 5 years?
The aerospace has been a focus area for Avalon, and as you're well aware, it takes a lot of time to get in, and once you're in, you're there for a long period of time. So usually, historically, we would have 5-year agreements, LTAs. Now with the global major, we have signed a 15-year LTA, which means the forecast for the next 15 years. So multiple segments. We are there in lighting now. We were never in cables. That launch is happening this quarter. Okay, and of course, previously we've talked about wiper blades. The first 2-3 prototypes have already shipped, and there are 153 type of wiper blades we're getting to production in the next 12 to 18 months. And this is a substantial piece growing into the next 10 to 15 years.
And thanks. The last question is now. Basically, you're looking for, let's say, shift your US to manufacturing to India. So what is the status on that, and where we are reaching that journey?
So the last year we decided we talked to customers during this, and it was a good time to talk to them when their numbers are coming down with the destocking. So around 55 to 60% of our customers agreed to move to India, and at various stages, they're at various stages. Some of it is already in production, but the big pieces are getting transferred back here. And I think this will be complete in the next 1 to 2 quarters. So around 60% of our existing business will move to India. But anything which is of clean energy, which has the IRA benefit, Inflation Reduction Act benefit, a lot of customers do still want to keep that in the US in the near term. And we are of a firm belief that in the longer term, the cost factors will play, and there's a good possibility that part of that could be moved to India.
Okay, sir. That's it from my side. Thank you.
Thank you, Arthur.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Hani Omia from HL Growth Fund. Please go ahead.
Yeah. Can you hear me? Hello?
Yes, we can hear you well, Omia.
Yeah. My question is, you've been keeping on saying that there's been a slowdown in the US, but yours is not the only stock I've invested in. I've invested in several companies. They have never said that. And I have relatives in the US. They said there's been no economic slowdown. So on what basis have you been saying that there's been a slowdown in the US?
Yeah, I'm not an economist, but I can try to answer your question. So what on the what I would say on the consumer side, you're not seeing a slowdown, but off late there's some slowdown. The consumer spending is strong. The U.S. economy looks strong from the outside. Most people are confused when it's, though inflation is high. But what we are seeing is that, Omia, that we went through COVID and supply chain challenges for 4 years. Last year is when we customers, apart from different industries, okay, not consumer, we are industrial, we are in aero, we are in medical, we are in auto. We saw across the board, because before June, April timeframe, the lead times for product were 40 to 50 weeks. Okay, either we kept inventory, customer kept inventory, there was a 50-week lead time. So when things slowed down and availability of components came back, they wanted to go back to pre-COVID levels of 16 to 20 weeks, which is the normal lead time we all deal with before this. And now today, the component lead times have come to that, so there's no supply chain challenges as you say. So now that's why we said customers destock for 5 to 6 months, and now we are seeing the restocking happening and them coming back at variable rates into the normal run rate they had. And these are customers who've been with us for 7, 8 years, 9 years in some cases. So it's not like it's a new customer. It's these are Fortune 500 companies, a lot of them working with us over a number of years. So it is more of a destocking and restocking. So in India, we're seeing a phenomenal growth. The whole country is seeing growth. But in the US, there is a slowdown, but that's supposed to be the largest market also. So you have to be wary of that only.
Okay. And with regards to the aerospace, you make all those sheet metal parts. You also have a competitor, I think, in Sansera Engineering. They also have started making sheet metal parts for aerospace. So how do you fare against that? And has the slowdown in aerospace something to do with the issue with Boeing?
No, see, of course, the slowdown in aerospace, we do around 4 to 500 different parts for planes. And of course, there is an issue with slowdown of certain models. We do see that. But for us, aero, the bigger pieces are forward-looking, where we are tooling up and doing. Sansera does a lot of machining, and they've been doing that for years. And for certain customers, we are the only vendor of choice for fabrication. And it's a completely 2 different models. So Sansera is into high-end machining, and they've been there for years.
Okay. All right.
That's invested in a larger project. That's what you probably are referring to.
Okay. Okay, that's it for me. Thank you. Thank you very much.
Thank you, Romeo.
Thank you. A request to all the participants, kindly use handsets while asking a question. Next question is from the line of Smith from Nivesh Investment Advisory. Please go ahead.
Yeah, hi sir. Good afternoon. My first question is, what are the major reasons for decrease in EBITDA margin? Is it due to decline in revenue because our gross margins are intact?
Yeah, I think I'll answer Subramanian here. So in terms of decrease in EBITDA margin, if you look at quarter on quarter, it's at a similar level. But if you look at comparing the previous year, it's come down, and mainly due to the sales coming down. And below the gross margins, about majority, 50% of costs are fixed in nature. So that has a negative operating leverage effect, which has led to the slowdown. But in quarters where we have good sales, which is like Q4 last year, you will see that flowing down into EBITDA, and we are at a mid to higher teens in terms of EBITDA margins. So that's how the nature of our business, and we are confident of reaching this as we move forward.
Okay, sir, that answers my question. The second question I have is, what are the reasons for decrease in revenue from clean energy, and are our customers delaying order due to some reason?
In a lot of cases, the orders are there to so that it's some of it has been with the destocking situation with the existing customers, but our larger customer projected is starting to ramp only now, which is delayed by at least 12 months. So that is one of the true reasons, and we anticipate in the 3-year period this is going to be our fastest growing segment for sure.
Okay, sir. I have another question. What is the percentage range cost of PCB in product sector, and it go up to like 70 to 80% in sectors like aerospace and defense?
So we are a little bit different if you look at the different sectors. For example, you mentioned aerospace. We don't do PCB in aerospace. We do cables, we do metals, we do plastics in aerospace. So we are not a completely PCB-oriented company. Saying that, a larger portion of our revenue comes from PCB and box build.
Okay, so what is the percentage cost in general if we consider of PCB?
So different industries, to be honest, have different margins you can command. If you look at the consumer space, it will be lower margins. If you look at the industrial space, it will be mid-level margins. If you look at some of the clean energy space, it will be a bit higher than the industrial. And it truly depends on the complexity of the work and the how much engineering is involved rather than the automation piece. Because if you look at the consumer piece, a lot of it is automated. If you look at, let's say, we are taking a interlocking system. It is a 1 crore to 2 crore system. There's a lot of labor and a lot of verticals going into it, not only PCB, cable, plastic, metal. So it's very difficult to say. By industry, you can say, the material margins differ.
Okay, sir. Sir, I have one last question. What is your outlook for the revenue and margin, and also for the US operations?
Yeah, in terms of our strategy, which we talked about, our US operations, in terms of the existing customer, we did talk about trying to move them, and then we have had good success in terms of trying to move out there. Okay, that's in terms of the existing customers. And as our MD talked about it, for some of our clean energy customers who get our IRA benefits, it will continue to be manufactured in the US. So moving forward, our focus will continue to remain on the market. US market is one of the largest and the most profitable market. We'll continue to focus on that and onboard the customers. And as we move along, our efforts will be to try and move to India. And that's our strategy. And that's playing out, and we continue to work on it. Margins will vary depending on the type of the product and the complexity of the product and where we manufacture. Of course, if we try to manufacture in the US, the margin has to be higher to justify the higher labor cost.
Okay, so can you give a ballpark number for revenue and margins?
In terms of the yeah, we talked about in the long run, we want to keep the mix as 50-50 in terms of US to India. That's what we work on. And it does vary between a quarter to quarter.
Okay, sir. Okay, that answers my question. Thank you.
Thank you. Next question is from the line of Darshil Zaveri from Crown Capital Partners. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question. Hope I'm audible.
Hello, Darshil.
Yeah. Hi. So, sir, I just wanted to ask regarding our growth and order book. So, could you just help me out? So, we are saying that we have an order book of 1,300 crores. So, that's executed over 14 months. And then there's another long-term contract. So, is the long-term contract included in the order book? How much part of it is? Could you just help us out in that, sir?
So what we break our order book into two pieces: the long-term contracts and immediate shippable orders. So when we say 1366 crore, it is what is executable in the next 12 to 14 months. When we say long-term contracts, which is actually grown by 58%. To 949 crore, if you look at it from last year, is what can happen between 12 to 14 months to 3 years. So where we have contracts, we count that separately. If that explains that to you.
Yeah, that helps a lot.
They're not the same.
Yeah, they're completely different. Yeah, perfect. So on that rate, sir, our growth should be much higher than what we are guiding for, sir, right? Because if we are going to execute around, we should be able to execute this in 12 months, right? So, and we are currently,
Are we losing your audio? Hello?
Hello, sir. Can you hear me? Hello?
I can hear you. We can hear you.
Yeah. So just I wanted to ask, sir, if this 1,300 crores we want to execute over a period of, 12 months, then is it possible that, our revenue guidance is a bit conservative, sir?
So like I mentioned, Darshil, so when we gave this guidance, once bitten, twice shy. Okay. Last year, we were off our guidance a little bit. So like I mentioned, we remain on track, but for a 3-year period. But this is a very conservative guidance from what we can see. Things can change positively, and we will confirm that in the ongoing quarters.
Oh, perfect. And so just wanted to ask regarding margins. So currently we were impacted by negative operating leverage, but as you had mentioned that in if we see Q4 FY23, we could even touch 15% margin with our revenue going to 270. So sir, so now going forward as we recover, our margin trajectory. So if I could just, if we are above 250, 260 crores, we should go back to our historical margin. Would that be a fair assumption, sir?
Yeah. So absolutely. So what we believe is, we have set up for a huge growth, and there's an unfortunate slowdown in 24. So you're going to see us go back to where we were, or even better in the future, for sure. It's operating leverage. Aramesh, you want to add something to that?
Yeah. Just to add to what MD said, in terms of we are, from a capacity perspective, we are designed for a much larger thing. And as our sales pipeline comes, gross margins we have been able to maintain sort of the industry-based standards. And with the current fixed cost, the margins should flow automatically in the EBITDA and PAT. And we have done that in the past, and we are confident of doing that in the future as well.
Oh, okay. So a 12% margin is possible for FY25, as a lot of our manufacturing is also shifting to India, which is already doing a 12% margin.
I don't want to be getting into specific in terms of numbers, in terms of what we be able to achieve. I think from a guidance perspective on sales we have done, and we have talked about the mechanism of how it works. I'm sure you can work with numbers.
Okay, perfect. And so just wanted to ask regarding our shift of manufacturing of a lot of customers to India, will that be margin accretive? And if yes, by how much, sir?
Well, I'll take that, Aramesh. Darshil. So we believe moving to India will be more profitable for the company, okay, because there's a cost which we are trying to reduce in the US. A combination of this will have a very positive effect. Did I answer your question?
Thank you very much. Darshil, I'll request you to come back for a follow-up question. Next question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. I wanted to understand, in terms of the direction where we are going as far as the U.S. operations are concerned. In this particular year, you did indicate that you did well on the EBITDA side, but at the bottom line, there was a loss. What is your roadmap on turning the U.S. business completely, as in becoming profitable over there? Do you think that's going to take that's a 3-year journey, or how much time will that take? That's the first part, because that will have a huge impact on the consolidated financials.
You're absolutely right, Rahul, and that's what we've been struggling through last year. In the first time we've had this kind of slowdown in the U.S. But saying that, U.S. is the largest market, and we also need that as a beachhead because we deal with some of our clients who have complex systems. They like to see some operation in the U.S. And also saying that we would have a smaller operation once a lot of these products move to India. And that journey has started 4 or 5 months back. Some of it is moved, some of them in motion. But any of the clean energy products, if we need to play in the U.S., we need to be there because of the IRA benefits the customer gets. So that is the question we are trying to answer. So anything which does not have an IRA benefit, we are moving or convincing customers to move. Okay, and we've been very successful in doing that. It's taking a little bit longer than we expected, but the choice is the IRA benefit is going to be there for some time, and we are hoping once it gets started, some of the subcomponents can move to India.
Assuming that, we are looking at a 50-50 share between US and India, even if clean energy were to be about 25 to 30% of the total revenue, and which is profitable, the US business is more profitable. When do you think, okay, let me just put it in a different way. Do you think the profit of the US, the EBITDA margin of the US can be higher than that of the Indian operations?
No, I don't think, as we see it now, of course, we raise prices, we can get the US to be higher. But as we see now, our core business, our most profitable business is the US customer making in India. And that is our core target. And for clean energy, we are giving a pathway to the customer to start in the US and then bring subsystems into India so they get the IRA benefit.
Okay.
Yeah. Go ahead.
Yeah. I wanted to also ask you about, I think you just fleetingly talked about having enough capacity. Do you see the company needing more capex in order to support future growth?
So we have always maintained a different model as we have spoken in the past. We usually strive for a 10x asset turn. And over the next 3 years, we believe our investments in the facilities or the larger factories are done, and we'll have a 35 to 45 crore every year to maintain growth, because we're also looking at labor arbitrage because of the U.S. customers. So we would look at, let's answer your question, 40 to 45 crores every year for the next 3 years.
Sure, and I'm not too sure if I missed this. You talked about a revenue guidance of about 14 to 18%, and I understand you're conservative, based on all the numbers over here. Did you talk about a specific EBITDA number? I don't know if I missed that or you did not give that guidance.
On guidance, we stuck to the top line, and we're not given specifics in terms of profit margins.
Okay, cool. Thank you very much, and all the very best.
Thank you.
Thank you very much. Next question is from the line of Neil Nadkarni from Dalal & Broacha Stock Broking. Please go ahead.
Yeah, sir. Thank you for the opportunity. Yeah, so I just had a couple of questions. The first one is regarding the new plants that you are getting online in India. So majorly what capabilities are you adding over there, and are you targeting some other geographies apart from US over there also?
Yes. These facilities will be mixed plants with, I think the new one coming up is where we're seeing the fastest growth areas. PCB, cable, plastics, it will be a mix. It's a 150,000 square feet facility, 3.5 acres, and we have got room to build more. In India, we do have the Bangalore factory, so the larger box build will be done in the new plant. We believe will come, the first part will come through late this quarter, early next quarter, and the larger plant will start construction once this is done. And so it will be a mixed bag. It's just not a certain category of parts. So we try to utilize our space in the best way possible. And we believe the longest lead time to get production going is not the machines, and it's the factories and facilities.
Yeah, and in the geographies front, are you targeting some other geographies also?
Yes, of course, Europe has been, we've been trying to get there. We have a few customers, but none of the larger people. A lot of our European customers, when they come to India, they use us quite a bit. It's not going back to Europe. It's like what we say in 24% of our business, if I'm right, I don't know, this quarter, comes from Japanese customers.
So, and also last quarter you had mentioned that you are planning to repay around 50% of your debt in Sienna also. So is that still on track for the FY25? And also, what are your capex targets? If I'm not wrong, it was around 40 to 45 crores for next 3 years, right?
Yeah, every year for 42.
Yeah, Subramanian here, I'll try and answer that question. In terms of Sienna, we have not completed the transaction. We are hoping that we'll be completing in next quarter in terms of repaying the debt there. We have a working capital of about $9 to $10 million there. We will do that. Okay. And in terms of capex, as Andy said, we will be on an average doing about 35 to 45 crores annually.
Yeah. And last question, sir. So on a long-term perspective, let's say over the next 2 to 3 years, so are we still targeting that 30 to 35% kind of industry growth on the top line side?
So because of our customer mix and because of our US, India, so what we are saying is in the next 3 years, we are comfortable to say we are going to double our revenues from today. But it may come in spurts. But if you look at us over a 3-year period, we look at our business over a 3-year period, we are very comfortable to double our revenues.
No, sir. Thank you.
Thank you very much. Next question is from the line of Uttam Kumar from Avendus Spark. Please go ahead.
Sir, thank you for the opportunity. Just 2 questions from my end. The first one is more clarity with regard to the initial statement which you had made on the growth engine, where we have stated that the new customers in USA regarding the clean energy space. Could you just give more clarity on what exactly we have received, because I couldn't clearly get it. And also there was a excellent commentary where that customer will also come for a significant revenue from FY26 onwards. So what could be the revenue composition which this particular customer can account for over the next, let's say, 3 to 5 years down the line?
Thank you, Uttam. So the first part of your question I missed. Because of sound?
So the first growth engines, you had mentioned that there has been a new customer addition in clean energy space, and we had received some approvals, etc. I happen to miss a commentary if you can.
Okay. I got it. So it's new customer. It's been a customer for a year in the sense we were stopped from making product because of compliances for the customer and engineering design issues, and that has been completed so that we are ready to go. We are into prototype now, and we're ready to go into full production in the second half of this year and some revenue in Q2. it's going to be a substantial piece. I will let it play out because huge numbers have been promised to us. So we just want to be more comfortable in giving guidance on the size of it. But it is fairly large.
Got it. So the second one is on the domestic, where, the aspiration of the company is also that both times you want to maintain a 50-50 mix between both India and international revenue. So in that context, so which segments are we looking to grow? Because right now we see that certain peers are performing well, be it in the industrial category or the medical category, whereas we are still struggling to grow up the business there. So what are we focusing on? What are our focus areas? Is the company planning to get into some newer categories or tap into some PLI opportunities there? More clarity, more color on that will be helpful.
Yeah, absolutely. So I'll just rephrase. See, India to us, 3-4 years back was around 20-25% of our business. It has become a focus for us in the last 18 months as the whole growth engine has started, and we want to be a fair part of it. So a lot of our focus historically has been in rail, which is growing for us and will grow into the future. Industrial infrastructure, again, some global majors for the supply into India have signed up with us. And we also have 2 fairly large China transfer projects moving from China to us for Fortune 100 companies at various stages for the India market coming in. But these companies, it's not an overnight story. It takes some time. So we believe the railways, infrastructure, and our EV, entry into EV, one of the large two-wheeler players, or going to be large two-wheeler players, will happen in the later part of the year where we have signed significant orders.
Got it. Thank you so much for that.
You're welcome.
Thank you. Next question is from the line of Ashutosh Paraskar from Abilis Investment Trust. Please go ahead.
Yeah, hi sir. Vipin Goyal this side. Thank you for the opportunity.
Vipin, sorry to interrupt you. Can you please speak for the handset?
Okay. Yeah, hi. Thank you for the opportunity. Sir, I had this question on the growth part of the business. You budgeted some 14 to 18% growth for the next year. So could you talk about the kind of products which would be the first ones to drive this growth for the next year? And then, if you had to break it down between the new customers versus the existing customers, or the new products versus existing products, so how would this basically kind of pan out in the next 1 or 2 years?
So if you look at most of our customers, in last year, around 80% of the revenue came from existing customers. Okay, they will grow at 10 to 15%. Okay, and what we are seeing is the revenue coming from new customers, which is where our larger part of the growth will be at a much higher rate.
Sure. Okay. And then, sir, if I look at the order intake for the quarter, so there's an improvement in the ordering. So anything you would like to highlight here on what kind of segments has led to this growth, or again on the product side, if you have to bifurcate that into products, so is there any particular product that led to this improvement?
A lot of it is broad-based, and a lot of it is a good mix between, I would say, between our U.S. customers and India customers. Okay, what we're seeing a comeback with the U.S. is going a little bit faster into the future. That's why we're very positive, and that's been our core business. And India businesses are in the day where we are doing a lot of prototyping for these industrial giants, and we're seeing that play out in the next 2 quarters. And these are substantial revenues which are supposed to come.
Got it. Okay, sir. Sir, and then coming back to this, some of the domestic customers. So earlier we were doing some surveillance system for one of the industrial customers, and then there's this domestic EV two-wheeler customer which we were trying to get orders from this year. So how's the development there? Any developments on that?
So EV, we do have the orders for the next 12 to 18 months. Okay, and we expect launch late part of Q2. And that's a substantial piece.
Okay. So again, like coming back to that existing product part of the portfolio, you said 10 to 15% growth in the existing product portfolio. So large part of this would still be mobility and then some bit of industrial. Is that the right understanding?
No, because a lot of that could be a lot of our clean energy destocking to restocking happening also. There was a slowdown there. So fairly broad-based. And then the aero side also had a tremendous slowdown, which we're seeing coming back to actually 4 year back levels as 2020, where we were at the peak at that point of time. So we are seeing it broad-based. And of course, industrial is a large piece of our portfolio. So we see that our largest industrial customers coming back to where they were before the destocking, which is around 8 months back.
Sure.
Did I answer your question, Nitin?
Yeah. I got some clarity on it. So this on the debt front, last quarter we had alluded some that we'll be paying some part of the high cost debt that was sitting on the balance sheet. So could you talk about what has happened there? And then last one on the US headcount, if you can give the number, how that has moved.
I'll take it on the debt side. Today, most of India is debt free. So we took some debt in the end of March in terms of about 30 crores. Come down the small working capital and contextual. But otherwise, today the key debt is in US, which is about $15 million. And that is what we are looking to rationalize. We hope to complete the transaction in Q1, Q2, okay, in terms of bringing the debt down there, okay, moving some of the surplus cash from India to US and then paying it down. Yeah.
Hello, Vipin. So we have reduced headcount.
And on the headcount in US.
Yeah, so we have reduced headcount. I don't want to give the exact numbers out, but there's a substantial reduction in headcount.
Thank you. Vipin, I'll request you to come back for a follow-up question. Next question is from the line of Raghav Gupta from Nomura. Please go ahead.
Hello, am I audible?
Yes, go ahead.
Yeah.
Hi, Raghav.
Yeah, hi, good afternoon. So just one question on the line of segmental revenue. So I need to just let me know the split of PCB, box build, ODM, and other electronic components. So I think in presentation of box build moves 1% up from 49 to 50 this year. I think if you could just let me know sir, about PCB, ODM, and other electronic components.
Sorry, the audio was not very good.
Raghav, your voice is coming a little muffled. May I request you to speak through the handset?
Am I audible now, sir?
Now it's perfect.
Yeah, thank you. I was just asking about the segmental revenue split for PCBA, ODM, and other electronic components. For box build, I guess it's 50% this year. What about other segments?
So I would put it this way in a simplistic manner. Around 65% is box build and PCB together. That means box build has PCBs and as the other pieces also. And if you're doing direct parts or something like that.
Very good. And other remain more or less the same, I guess, or the ODM.
Yeah, you can say that.
Got that. Thank you for the question. Thank you.
You're welcome.
Thank you. Next question is from the line of Harshal Sethia from Renaissance Investment Managers. Please go ahead.
So with the new Chennai facility, what kind of capacity will we have in hand? And how much have we spent on the Chennai facility, if you can just highlight? I just missed the initial comments from me.
How much you want to answer that?
On the Chennai facility, that's about 1.5 lakh square feet of space and about 3 acres of land. That's within the SEZ. And it has an existing building and we are doing the refurbishing. I think all put together, it will be about 30 crores in terms of including the cost of the building and the refurbishment. Okay. This is all in cost I'm talking about.
30 crores.
And out of that has been accomplished already.
Yeah, and as we earlier said in the speech, we should be commissioning the building in this quarter.
And the 35-40 crores that we are planning to spend each and every year for CapEx will be for Chennai and Bangalore both?
Yeah, this is as a company as the group as a whole we are talking about. We will have both buildings and the machinery. So all of these projects are spread over years, sort of. It doesn't get executed in 1 year.
Okay. And sir, so 3 years out, we might be having a gross block of around 270 to 280 crores. Do you, around say 280 crores, do we expect to maintain the same level of asset turns that we are doing as of today?
How much you want to ask?
In terms of our model, as we earlier said, asset model will continue to do that. And there may be few blips here and there in terms of the quarter-on-quarter, but in the long run, our business model continues to aim for achieving asset turns.
I'm just asking from a longer term time frame, not on quarter-on-quarter.
Absolutely, we'll be able to maintain.
So, which is around 7 times, which which we have been generally doing.
No, it may be much more higher also. Yeah.
Okay.
We target a 10-time turn usually. Yeah?
Okay. Understood. And and you said that the facility will be up and running in a phased manner. So you said that in Q1 there will be a bit of commissioning, and then the phase 2 might start from H2 FY2025, correct?
No. So there are 2 facilities. One is in the export zone, which will be fully commissioned late this quarter and the beginning of next quarter, which most of the work is done. That is for export. The second facility, as our India business is growing, so we have a brownfield project which will be live. Part of it will be live end of this quarter, and new construction, which we already have the land, will start, I would say, in the second half of this year to cater to the Indian market in the future.
Thank you very much. Ladies and gentlemen, we will take that as a last question. I will now hand the conference over to Ms. Bhumika Nair for closing comments.
I would like to thank all the participants for being on the call and the management for patiently answering all the queries. Very much appreciated, and thank you very much for giving us an opportunity to host your call. Wishing you all the very best, sir. Any closing remarks from your side, sir?
Yeah, I just added a couple of lines, if that's okay. We are encouraged by the robust support from our investors despite challenging market conditions. We are committed to reinforcing the trust that the investors have in our company. I sincerely appreciate your steadfast support and confidence in Avalon Technologies. Together, we are set for a remarkable journey of profitable growth and success. Thanks to everyone for attending the call. Thank you, Bhumika.
Thank you very much. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.